Good afternoon, everyone, and it's great to have this opportunity to present this tax and exchange control update. Is probably a strong word. I'd probably refer to it more as a flash update, because in 15 minutes, I must say, we can't do justice to what's been going on the tax field and certainly not on the exchange control side. So lots of changes on the go. And let's start with a look at the tax landscape and maybe just a little bit of reflection on what happened during the course of 2020. And we all know, the pandemic hit. Governments around the world were scrambling. Disaster relief measures were put in place, and South Africa was no different. So we saw the proposals come through, the relief measures come through, and I must say, overall, government did do everything in their powers to try and help employers to retain employees and to help business generally. So if we have a look at a bit of a snippet of what government put in place, we saw the PAYE deferral for qualifying employers. They could pay off their PAYE over a period of time. And in fact, the installments ended this month. Skills Development Levy, that's the 1% levy on payroll that employers pay. They received a holiday over a period of time. And donations to the Solidarity Fund, of course, those were put in place. And we were incentivized to make donations to that fund. And PAYE relief was also given to employees via their employers in the event that they did make these donations. And that TERS program that was administered through the UIF, I must say, that was quite something. And at the end of the day, there were lots of hiccups, but also good work was done there. So lots of relief measures in place, millions of payments made through that system. And in fact, those ran out yesterday. So the extension of the TERS program for very specific industries and conditions applicable ran out on the 15th of March. And then the employment tax incentive was also expanded to help employers and increase their payouts on the ETR. And then just more generally, measures that came through for taxpayers. And again, you had to be a qualifying taxpayer, in which case you could defer your provisional tax payments. Your first and second 2021 payments you could reduce and then pay the additional amount at a top-up 6 months after the year of assessment. So some nice relief there that we've certainly used for our clients. That category, to assist with cash flow and VAT refunds. You could change from a 2-monthly return to a 1-monthly return. The Tax Administration Act, we saw timeframes put on hold during hard lockdown. And I must say that's something just to bear in mind. If you have missed some deadlines with SARS, it might be that you can slot into that timeframe and get that additional time on your side. So just bear that in mind. And another important one is for South African residents that went overseas to work. And a portion of that remuneration then is exempt from tax in South Africa in terms of Section 10102. And that's 1.25 million rand. There were up to 1.25 million rand that's exempt. The balance is taxable in South Africa. And the conditions that apply in order to qualify for the exemption are that you have to have worked outside South Africa for at least 183 days during a 12-month period, and 60 days of that must be consecutive. And the relief that we've seen come through there is that they've reduced 183 days down to 117 days, and that's for both the 2020 and 2021 tax years. So for those of us that were stuck in South Africa, not able to get back to our employers overseas, we do see the ability to use that relief. So then moving on to the 24th of Feb 2021, and our Minister of Finance announced his budget proposals. And the budget is always a fascinating thing for me. And, we wait with bated breath to see what's coming. And those corridors in Treasury, you kind of hear them echoing as they are whining about this and trying to close that loophole. So this always gives us an insight into what's going on behind the scenes. And always interesting is to have a look at the stats and to see where our tax is being collected from. So we see Tito and his team plan to receive 1.35 trillion rand in the 2022 fiscal year. And that is predominantly going to come in via personal income tax, 38.2%. That makes up the next biggest chunk, 27.4%. And corporate income tax, a paltry 15.8%. And over time, that percentage has been dropping. And really, that's a factor of the economy. So kind of par for the course and a real worry in terms of overall contribution. And then you get the rest. You look at the song and dance that's placed on some of those other taxes. And really, they are insignificant in the scheme of things. And I just wish that government would focus on the low-hanging fruit and not worrying about the complex other collections. But it is also useful to note the differential between direct taxes that you and I feel in the pocket because we physically pay that to SARS versus the indirect taxes that are kind of surreptitiously sucked out of us as we spend our money. And that differential is 58% direct versus 42% indirect. Then moving on to some of the highlights that came through in the budget, and there's no question in my mind that an absolute highlight was no change to capital gains tax, dividend withholding tax, and VAT. I think most of us were expecting something on the front there. And then also the announcement that they were going to scrap or have scrapped their additional tax target over the next 4 years of 40 billion rand, because that would have seen some drastic increases in tax rates and additional taxes. So thank goodness that's been scrapped. The reduction or the proposal to reduce corporate income tax down to 27% from 1 April 2022 is most welcomed. And they're telling us that they're not going to stop there. So the proposal is to continue with that reduction over time. And that's contrary to where other countries are sitting. Of course, we weren't competitive. At 28%, we're not competitive on a corporate income tax rate. But other countries are going to be moving up where we are targeting a downward movement. But sounds wonderful on the face of it. But Tito was quite clear. It's a zero-sum game for government. So they are going to limit interest deductions and assessed losses. So we've seen the murmurings in the past, but it's now going to happen from 1 April 2022. So we just need to be prepared for that and think about how it might impact our businesses. Personal tax brackets, we saw those stretched by 5%, which is fabulous, above inflation. And then rebates also increased by 5%. So as a result, what happens when rebates increase is that the tax thresholds increase. And you see those there in front of you now. So let's look at a practical example of a retired couple, both over 75 years of age, living off their interest income. And they've invested 4.64 million rand each in fixed deposits. Those are paying 4% interest per annum. So each of them earns 185,600 rand. So between the two of them, 371,000 rand is what they're living off. If we now ask ourselves, well, will they have to pay tax at that level of taxable income? Let's run the tax calc. So we see the exempt portion of the interest for a taxpayer over the age of 65 or 65 and over is 34,500. So their taxable incomes are 151,100 rand per annum. And lo and behold, that's the tax threshold into 2022. So they won't have to pay any income tax on that level of income. which often surprises people because that's kind of higher than most of us anticipate. Then looking at some of the other significant amendments that came through in the budget. The first is always the fuel levy. And I think most of us look at that and kind of yawn now because we're so used to it. But just bear in mind, 1 April 2021, fuel prices will increase. And take a step back, and just every time a litre of petrol goes into your car, R6.15 you're contributing to government. And a litre of diesel, R6.01 goes to government. So I think government needs to thank us a little more on that front. And even more so when you go to the bottle store. You buy 750ml of spirits, a bottle of spirits, and you pay R74.23 to government. A carton of 20 cigarettes, R18.79 goes to government. So no surprise there why the illicit trade of alcohol and tobacco is so rife. There are a number of tax incentives that are going to terminate when they reach their sunset dates. But the two that are going to be retained are the Urban Development Zone and the Section 12H learnership allowances. And we certainly use those extensively, the 12H allowances. But just take note, if you're involved in any of those, there will be changes. And the one that is quite significant, because I've seen an uptake on the Section 12J venture capital company deductions for contributions made. The sunset date is 30 June 2021 for VCCs, and that will not be extended at this point in any event. The proposal is not to extend because wealthy taxpayers are getting all the benefit and small and medium enterprise is not reaching the targets that government had hoped as a result of this incentive. Unfortunately, and I'm sorry to say that the wealth tax is still on the cards. They've been beating this drum ever since I can remember. It's been deferred ever since I can remember, but it's still there. So just be aware. And then I must say, this comes as a relief to me because really SARS, that wonderful e-filing system, when it was first introduced, was cutting edge. And at the moment, it's hanging together on straws. So a 3 billion rand budget is much needed by SARS. My only hope is that they spend that wisely, because we all know what sort of track record government's got on that score. And then I think under the new regime of work from home, travel and home office allowances are no longer fit for purpose, and thankfully they will be reviewed, so watch that space. Let's just spend a second on trusts and look at trusts as an estate planning vehicle. Of course, they're useful for other purposes, but really their main driver has been estate planning. And trusts were funded by way of a sale of assets on interest-free loan, or cash being lent into the trust on interest-free loan. The growth assets grew in the trust, and the loan was pegged in the hands of the lender. So a wonderful estate planning tool and useful for other purposes. Well, March 2017, we saw the first anti-avoidance provisions put in by SARS, and loans or low interest loans made to trust from that point forward are subject to a deemed donations tax. And so too are loans to underlying companies, part-owned or wholly owned by trusts, that were also then subject to the donations tax, the deemed donations tax. And then in 2019, we all come up with these good schemes to avoid certain taxes. So a preference share scheme that was put in place to convert loans into preference shares, that was closed down because those are now also subject to the deemed donations tax. And finally, we now see inter-trust loans also being targeted. And we're going to see those being pulled into the Section 7C provisions from when we don't know, but watch out for that. So essentially, that's the tax flash for you and an update on what you can expect. Let's move on to the exchange control provisions. And two very important changes that have come through recently. The first deals with loop structures. And a loop structure is a structure that a South African resident individual or company sets up offshore, and that offshore structure then invests back into South Africa and has the ability to extract value out of South Africa over a period of time. So that's a loop, and a loop has been prohibited in the past. There's been some gradual relaxation to allow foreign ownership, a threshold of foreign ownership. And finally, on the 4th of January 2021, we see a circular released that lifts all restrictions on South African loops. So I must say, this presents a wonderful planning opportunity. Families with family members dotted all over the world, which is becoming a reality in our lives. This now gives us an opportunity where we didn't have previously to be able to potentially plan, where we've got those mirror offshore structures that are costing a bomb. We've got family in the USA that we want to benefit from the structures, but the USA tax rules are so prohibitive. You give them a cent out of that offshore trust and they won't see a cent of it. It'll go to the USA Treasury. So here comes some opportunities which are great. Bear in mind that this you can only avail of the loop structure relaxation with authorized foreign assets. You can't use illicit foreign assets for this purpose. And there's no pre-approval to put the structure in place. You put the structure in place now, and you then go and report to your authorized dealer or your bank. When the structure is finalized, and then annually thereafter, there is a reporting requirement. So unfortunately, you're not out the woods completely, and there is quite an onerous reporting requirement. And typically the information will be chapter and verse in terms of what you've done, what the assets are, what the amounts involved are, etc., etc. Where your structure involves an inward loan back into South Africa, the normal ex-con rules will still apply, and pre-approval must be sought. And then one issue that is going to be ongoing, and I think quite difficult to evidence, is that all transactions between your foreign company, your foreign structure, and your local structure into which it invests must be at arm's length and at market related values. So that's important. Pre-existing loops, unfortunately, cannot simply be slipped in and hidden behind this curtain. You will have to regularize those separately, and you will be subject to a levy. I've been down this road a couple of times. And then finally, a point on financial immigration. And Andrew mentioned the implications around taking out your retirement funds. Well, with effect from 1 March 2021, the term financial immigration no longer exists. So, in the past, when someone left South Africa, you still had a bit of a dilemma as to whether you wanted to formally, so you would break your tax residence, and then the question is whether you wanted to formally emigrate through the banking system, submit your MP 336, and then any assets you retained in South Africa would be blocked and under the control of your bank. So that all falls away from 1 March 2021. And what drives the process in future, whenever you want to transfer funds out of South Africa, is your tax status. So what does that mean? That means that we have to run to SARS to go and get a tax clearance certificate, a tax compliance status for foreign investment, for good standing, or for immigration. And a TCR01 is the application form that needs to be completed via the e-filing process. And you then run along to your bank with your tax clearance, and the bank can then transfer your assets abroad. So on immigration in future, the 1 million rand discretionary allowance remains. And in addition, you then get 10 million rand per person to take out, but subject to tax clearance. And then in addition, you can take an amount above 10 million rand, but that will be subject to quite an onerous audit, both by SARS and by the Reserve Bank. So that's the only time the Reserve Bank will get involved directly, is when you want to take out amounts above the 10 million rand limit. And then in future, any additional amounts that you leave behind in South Africa and then want to take out, you will have to then get tax compliance for, present that to the bank, and then be able to take that out. Your 1 million rand discretionary allowance will apply into the future, and that won't go away. So I think that is it from my formal presentation. Thank you.